Good morning. Welcome to Market Mashup, our recap of financial markets and what's in store in the upcoming weeks that might impact your stock and bond portfolios. I'm Scott Nasca, president of Generation Capital Management. We had a strong week and pretty much month and year to date so far for stocks. For the month of March, S&P 500 was up 3.1%. Dow Jones was up 2.1%, and the Nasdaq was up 1.8%. And for year to date through the first 3 months of the year, we have the S&P up 10.2%, the Dow Jones up 5.6%, and Nasdaq up 9.1%. So across the board, really a strong market for stocks for the first 3 months of 2024. Once again, still favoring growth over value as the Nasdaq was considerably outperforming the Dow Jones in that respect. On the bond side, generally the bond markets were lower for the year so far. Outside of the shorter duration maturity bonds, 1 year and under, you saw some drops in bond prices due to higher yields, and it results in flat to negative rates of return. Spread that we always like to focus on, the 2-year, 10-year spread came in at 39 basis points, with the 2-year at 4.59% and the 10-year at 4.20%. So this is something that's been going on for about 18 months right now, this inverted yield curve that we're still seeing between the 2s and 10s. And it does, like I said in past, lead to economic slowdowns and potential recessions out there. So we still want to keep an eye out on that. Some of the precious metal indicators, gold's at 22.14, as well as oil is at 83.96. So on the commodity side, still see some strength in oil and gold as the fears of inflation continue to go higher. You're seeing it in the prices of gas across the board, as well as other oil-related industries out there. So it's not a strong sign for keeping prices lower. It's still going to cause some problems for the consumer down the line. In terms of the economic data points, still strong economy for at least the first 3 months. We had the GDP higher by 2.8%, strong showing for the Q4 out there. We also have CPI higher, and employment is also higher. Across the board, you're seeing still some economic growth, which is causing the Fed to hold back a little bit in terms of lowering rates. At the beginning of the year, there was talk of 67 quarter-point rate drops this year. That has now really moved down to 2 to 3 potential eases that could take place this year. And what's happened is you've seen the yields on bonds move higher, prices move lower, and that's been the reason why the bond market has not been a great investment vehicle for the first 3 months, other than the shorter end of the curve, where under a year, where you're still getting a nice, healthy 5+ yield from U.S. Treasuries and T-bills that are out there. If you have any questions, feel free to reach out to us. Our website is www.gencapmgmt.com. Our team is ready to answer any questions that you might have. Give your portfolios just a second opinion, second look. Make sure that your allocations meet your goals and objectives. It's very important, especially as you start a new year, to make sure, especially with the volatility in the markets, that you understand the risks that are out there and how your portfolio will react under certain environment. April is bound to be somewhat of a volatile month, and we'll look forward to seeing if we get some signs of relief in terms of interest rates, which will also help stock markets going forward, or if we're going to see continued inflation taking place within the oil sector, and pay attention to gold as well, because that will also have an impact in terms of a safe haven vehicle where investors want to allocate their money. So feel free to reach out to us. Our team's ready to answer any questions that you might have. I'm Scott Nasca, president of Generation Capital Management. This is Market Mashup.